Hello, grade 12s. Welcome to the Mindset Learn Exam Revision School. Now, we have already started with the exams, and we hope so far things are looking good on your side. We hope you guys did best with your English exam, and now we will be preparing for your accounting exam revision. But I go by the name of Queen Matusa, and of course, I'm not alone. We've got the awesome Ashraf in the house with us today. How are you, Ashraf?
Good, and you, Queen?
I'm well, thanks. So Ashraf will be
great.
taking us through the show for today. And can you just let us know exactly what we'll be covering for today?
We've got a wide range of questions, questions that the matriculants need to know to be prepared for tomorrow's paper. And so they have to listen to us. We want their mind, their body, and their souls for the next 1.5 hours.
Yes, you heard it, guys. We hope you've got your pens, your papers ready, your books, and we also hope that you guys will be with us throughout the show, because I will be with you live on Facebook, our social media pages, where we can ask questions and interact with us if there's anything that you need help with. So let's get started with the show.
Thanks, Queen. Okay, guys, we a few seconds away from that paper for tomorrow morning.
Yes.
Now, just a word of advice. Tomorrow at 10 to 9, the entire country will be sitting with their accounting papers in front of them. What is expected of you? Surely you are given 10 minutes of reading time, and therefore, my advice to you is during that reading time to look at your answer book. That's right. Why the answer book? The answer book will give you a particular focus. It will set a theme for you, so you'll know exactly what is being questioned in the paper. It will give you an indication of what you expected to know with the relevant sections in your exam. So obviously, by looking at your answer book, you have a clear indication of what you're going to answer first. No rule anywhere says that you must do question 1 first, because you have an answer book in accounting. And look at the answer book. Once you've decided, this is my favorite section, I'm going to start with this particular question. Why? Because when you do that question, then automatically you go on to a high, and you're on an accounting high, and therefore I'm sure everything will go A for away for accounting. So those are just basic examination tips that I think is important for every matriculant, every accounting matriculant out there in the country. That's what you guys have to do. And obviously at 9 o'clock, you start answering your questions. Okay, so Queen, do you think that would help them?
I think that's going to help them, because I remember I used to think that we had to start with question 1 for every paper. But when I found that out, I was like, great.
Exactly, and in accounting specifically, because it's an answer book, so you can start anywhere in the answer book. Right,
wow.
guys? So, let's look at our examination preparation. What are we looking at? Obviously, we're going to work through various exam types of questions in preparation for the final exam. Let's start off with an appetizer, a starter, something to get the adrenaline pumping. Simple. The question says, choose the audit opinion from column A that best describes the audit report in column A, right? So you're going to choose from column B and match it with the relevant audit report from column A. Next to the question, and obviously you number it. Now, let's look at our audit reports. The first one says, now obviously in your audit report, you have to read your audit report to understand it. Watch. In our opinion, the annual financial statements fairly present in all material respects the financial position of Shaba Limited as at the 28th of February 2013. Now, immediately you can see that this report tells you that everything is hunky-dory. That means they haven't mentioned anything to the contrary. It's in accordance with, they're telling us it fairly presents, gives you an indication in all material respects. So what does it tell you? What type of an audit report is that? You're going to match it with column A. So let's find something that tells us that this is what we call an unqualified audit report. Understand this. We've said this before. An unqualified audit report is a good report. Do not think of it in terms of your qualifications, like the person has a degree, etc. No. An unqualified report tells you we're accepting the report as is because whatever we have checked is in accordance with GARP, IFRS, etc. So in this way, you can clearly see that that is an unqualified audit report. Okay. Just another terminology sometimes you use. People use what we sometimes they'll mention an unmodified, and that one sometimes explains it better because it tells you we didn't modify, we didn't change anything. Why? Everything was in accordance to what we have checked. Okay. Number 2, we have not been able to obtain. We have not been able to obtain sufficient audit evidence to provide for an audit opinion. Accordingly, we do not express an opinion on the financial statements of Kotule Limited for the year ended 28th February. Again, this tells you something. What are they saying? We have not been able to obtain sufficient audit evidence, right? Obviously, that means something is drastically wrong there. So what are the auditors saying? Sorry, but accordingly, we do not express an opinion. And this is what we call a disclaimer report. What is a disclaimer report? Remember, you can also use the terminology withheld. That means, unfortunately, we could not find the evidence, and therefore, we are not expressing an opinion. Okay, and the third one that we're looking at, in our opinion, now can you see? Watch this carefully. In our opinion, except for the effect of the unauthorized interest-free loan to the Chief Executive Officer, the annual financial statements in all, but can you see, there's a catch word that you have to look out for. There's an operative word. And what is the operative word here? The operative word is except, but. Okay, it's fine, but something is not hunky-dory. This tells you that we'll accept the report with changes. We will qualify the report. Therefore, you find that one there will be what we call our qualified. Let's take it there to our qualified. Now, a qualified report tells you that it's a modified report. It's a report that needs to be changed. It's okay, but this needs attention. In this particular case, there was an unauthorized interest-free loan to the CEO of the company. So, just to get the adrenaline pumping, an appetizer question, audit reports. Understand them, make sure you can apply them in a situation, and I'm sure if there's a question of this nature, you'd be able to ace it. Even Queen now understands the 3 types of audit reports. Okay, great stuff, guys. Let's go on to the next question. Fixed assets, right? Computers were stolen on the 28th of February 2014, the end of the financial year, right? Okay, now, the computers were originally bought on the 1st of December 2012 for 54,000 Rand. The depreciation rate on the computers is 33.33% on cost, and the insurance claim of 20,000 will be processed during April 2014. Now, obviously, this question can take the form of an adjustment, or it could take the form of opening up specific ledger accounts like your asset disposal, etc. I want to show you a method on how to go about calculating what we require. So, when you're given a question like this, start off with this here: depreciation, cost price, accumulated depreciation, carrying value, selling price, profit or loss. Right, so immediately what are you doing? You're opening up a table and you're going to put in the relevant information into this table. So let's find the information. The computers were originally bought on the 1st of December 2012 for 54,000 Rand. So immediately alongside my cost price, I've got the amount of 54,000 Rand. That's the cost price of my computers. Right, where am I working? I'm working on the 28th of February 2014, the end of the financial year. So obviously you can see that your accumulated depreciation is not given to you. You have to now calculate it. Okay? Let's find out in the first year from December. So it's December, January, February. Correct? That gives you 3 months in the first year that you utilize the computers. Therefore, we use ART. You remember ART? Our amount, rate, and time. The amount was 54,000. My rate of depreciation was 33 1/3. And the time was 3 months, 3/12. Let's do the calculation. We got 54,000. We've got 54,000 times 33,333 recurring percent is equal to, divide by 12 times 3 should give you about 4,500. Obviously with a rounding factor, your figure is 4,500. Right, now what happens? Notice here that in your accumulated depreciation, right, you've got a figure of 4,500 for those first 3 months. Okay, so there's my 4,500. 4,500 as my accumulated depreciation for what period? For December to February of that first year. Now, looking at my financial year, obviously that then took me to February of 2013. Now I come to the current financial year, which starts on the 1st of March 2013 and ends on the 28th of February 2014. Got that? So now I work for the entire year. Same story. What do? Once again, 54,000 because it's on cost. 54,000 times 33 1/3% times 12/12. Let's do that. We got our 54,000 times 33,33 recurring, obviously because of the rounding factor. You're going to see we're going to pick up a problem, and obviously you'll notice that it will tell you the figure is 18,000 Rand. Now if you come to your second part of your entry, now what are we looking at? We're looking at the current financial year. And in my current financial year, my depreciation amounted to 18,000 Rand. So immediately I say 18,000, obviously that would be my final figure. 18,000 Rand would be my depreciation for what period? For this financial year. So I add the 18,000 here to my accumulated, because what's my double entry? Debit depreciation. Why? It's an imputed expense. Debit depreciation. Credit accumulated depreciation, 18,000 Rand. So I add 18 plus 4 is 22,500. Okay, that's the total accumulated depreciation on that particular computers. Right, now I now calculate my carrying value. How do I do that? Watch, very simple. Your cost of 54,000. 54,000 minus your accumulated depreciation of 22,500 will give you a carrying value of 31,500. Okay, I've got my carrying value. Remember what has happened here. What were we told? The insurance claim of 20,000 will be processed during April of 2014. Right, so 20,000 is the insurance claim. In other words, my selling price is 20,000. So now, If I take my 31 minus my 20,000, okay, it gives me a figure of 11,500. Now watch this very carefully. My selling price is less than my carrying value. And because it's less than my carrying value, it means that we have made not a profit, but a loss of 11,500. Okay, now, this is my calculation, depending on what the question asks. I'm sure you are anxious to find out what was the actual question here. This was just a calculation. So to find out what the question is, we're going to just pique your interest a little bit. We're going to take a mini break. Don't you stray or go away, because we'll be right back.
Yes, you've heard it from Ashraf himself. We will be right back. So while we take this break, you just think about the question and the answer. We'll see you after this. Welcome back, grade 12s. We're still doing the accounting exam revision brought to you by MTN. And we know that you guys have a big exam tomorrow, but there's also a very important exam that we are all going to write in our lives. And this is your learner's license as well as your driving test. So guys, please make sure to get yourself a copy of the K53 magazine, or you can also buy the app on the Google Play Store. You can also get it on the Samsung App Store. It's easy and available to you guys just like that. Make sure that you get yourself a copy, and remember that we have the competition online. So remember that, just go into our Facebook page and we'll give you all the details on how to follow and enter the competition. Let's get straight back to it, Ashraf.
Thank you, Queen. Guys, remember we were busy with asset disposal. Now, what are the possible questions that you could be faced with in the exam? Number one, obviously, if this was an adjustment, you needed to calculate the loss on sale of asset. Am I right? Absolutely. So in your income statement, one of the items under your operating expenses would be loss on sale of asset of 11,500. Now, very important, how do you show this in the exams? Watch here. You've got your cost price of 54,000, right? 54,000. Well, here's your bracket, minus the 4,500, minus the 18,000, okay, and then minus the 20,000. And you can see here that obviously what has happened, we have sold this asset at a loss of 11,500. However, it may be possible that you are asked to do a component of the balance sheet as well. And if you were doing the balance sheet, remember, there's something very important here. This selling price of 20,000 Rand, let me take you back to the question just to refresh your memories. What did it say? It said there that the insurance claim of 20,000 will be processed when? During April of 2014. In other words, we have not received that money as yet. And therefore, that insurance claim will appear where in your balance sheet? That's right, under trade and other receivables. So, if we were doing the balance sheet, under my trade and other receivables, I would have an item called insurance claim, right? And that would be the 20,000 Rand that we are going to receive from the insurance company. Is that crystal clear? Okay, so keep all of this in mind. Also, very important, if you were doing the balance sheet, then this carrying value here is of particular importance for note number 3. Why? In note number 3, what do we say? Disposal at carrying value. Okay? Keep that in mind, guys. So you can see the relevance of this table, how important it is. It's a mere calculation, guys, but this calculation allows you then to answer any question that is phrased on this fixed asset which involves a disposal. Is that clear? Queen, I think we had a question.
Yes, we had a question from a couple of mindsetters.
Right.
And they wanted you to please just thoroughly explain to them what the fixed asset register is.
Okay, guys, the fixed assets register. Now, obviously, if I ask you how many pupils in your class, and you'll say 20, 25, whatever, but the particulars and details of each pupil would appear separately in a register. By the same token, a fixed assets register will give you information about a particular vehicle. In other words, when was the vehicle bought? What's the rate of depreciation? If there was a disposal involved. So all relevant information. If you want to know what are the specifics about a particular vehicle. So in other words, you may be given one asset from your fixed assets register, and from there you will see, okay, this is when it was bought, this is the method of depreciation, we've depreciated it for so many years, etc., etc., etc. Based on that point, maybe a good idea is just to take a very simple example and see if we can just explain this one here. Cost price, 100,000. Accumulated depreciation is 95,000. Okay? You are now asked to calculate depreciation at 10% per annum on cost. Okay? Let's do that. 10% of 100,000 is a simple calculation, and my answer is 10,000 rand. Isn't it, Queen?
Yes,
Easy one, isn't it?
correct.
We don't need a calculator to do that one.
No.
Right, now watch. Is my depreciation on this vehicle the 10,000 rand that I've calculated? And my answer is no. Why not? Because, and listen carefully please, because if I process this 10,000 rand as my depreciation, whereby I debit depreciation because it's an expense, an imputed expense, does not affect the flow of funds, and therefore, when I'm doing my cash flow statement, I add back depreciation because it's a non-cash item. Okay, now watch, I'm drawing your attention to the cash flow as well. But coming back to this one here, if I add the 10,000 rand here to accumulated depreciation, what happens? My accumulated depreciation moves to what? 105,000 rand. And obviously, it means now that my carrying value would be a negative 5,000 rand. Be wary of this in the exams. Why? Because when you are faced with a situation like this here, ignore the 10,000 rand. Why? Because it means that you cannot use the 10% because it would result in your asset having a negative value. And we all know that an asset is something that has a value. Therefore, when you are confronted with something like this in the exams, what do? Cry? Panic? No. Don't fear when Ashraf is near. Okay? So what do, guys? Very simple. Look at your accumulated depreciation and say, fine, I've got 95,000 rand in my accumulated already. I want to be left with what? I want to be left with cost price minus the accumulated depreciation, which is equal to my carrying value, So cost price minus accumulated is equal to my carrying value. What do I want? I want to be left with a carrying value of 1 rand. Okay, I've already got 95,000 in my accumulated depreciation. So the maximum depreciation that I can write off is 4,999 rand to give me what? 99,999 rand as my accumulated, a cost price of 100,000. Therefore, I'm left with a carrying value of 1 rand. Please watch out for this. It's very important, especially when you're doing questions on depreciation. And what do you look out for? What's important? What are indicators that this may be a possibility? One, you're working on cost. And if any mention is made that we're looking at old equipment or old vehicles. I think we've exhausted that question. Can we move on to the next one?
Yes, I think we can move on.
Thank you very much. Okay. Next question. The following relates to the mortgage loan from Zola Bank. What are we told? The mortgage loan at the beginning of the year was 300,000. Interest that was capitalized amounted to 8,000 rand. Okay? There was a repayment of the loan and the interest for the year amounted to 56,000 rand. Right? Your capital repayment of the loan will be the same in the next financial year. Right? Immediately. This draws your attention now to the following. Whenever you are working with a non-current liability, remember, you have to separate your non-current liability into two components. And what are my two components? My two components are the portion greater than 12 months, which becomes my non-current liability, and the portion repayable within 12 months would form part of my short-term loan. Right, let's look at what the question is expecting us. Exactly like I mentioned. Can you see? The question wants you now to show the component of that loan. And the breakup is non-current liabilities, loan from Zola Bank, and the current liabilities. Again, where do we start off? Right, very simple. Very simple. Let's take this here in the form of a T account. Right? Let's put in the information. My balance at the beginning of the year is 300,000, therefore 300,000 in my loan account. Okay? What happened during the year? During the year, we capitalized interest of 8,000, and the entry to capitalize interest, grade 12s, is what? A debit to interest on loan, because it's your expense, and a credit to your loan account. Why? The loan is being capitalized. Capitalized basically means you're adding the interest to the loan account. And that's what happens actually in reality. So once again, my double entry is a debit to interest on loan, a credit to my loan account of 8,000 rand. There the loan has now been capitalized. Got it? Okay, let's move on. Now we are told that repayments of loan and the interest for the year amounted to 56,000 rand. What is the 56,000 rand? The 56,000 rand is the bank payments that have taken place. Once again, double entry, a credit to bank and a debit to my loan account. Why? Because I've paid off the loan. So obviously the loan being a liability, decreasing in value, is credited. So what have I done here? I've slotted in the three components that are given to me. What do I now determine? I now determine what is my closing balance. Let's do that. So we got a balance of 300,000 plus the 8,000 interest that was capitalized minus the 56,000 rand that we repaid gives me a figure of 252,000. Okay, right. So the 252,000 is my balance at the end of my financial year. Now be careful. This 252,000 rand is your closing balance, but something is going to happen within the next 12 months. What is going to happen? Within the next 12 months, you are told in the question. What are we told? The capital repayments of the loan will be the same in the next financial year. So number one, establish what was my capital repayment. And watch how we do that. Very simple. How much did you repay? You repaid an amount of 56,000 rand. So therefore, 56,000 rand was repaid, right? But that was not the entire, including the 56,000 rand, there was a component of interest as well. What was the component of the interest? The interest was 8,000 rand. Therefore, you can see how much did we pay off. If you take out your calculator, a very simple calculation, 56,000 minus your 8,000 of your interest that you repaid to give you a figure of 48,000 rand. What was the 48,000 rand? Grade 12s, the 48,000 rand was the capital repayment on your loan. Now therefore, coming back to my question, watch here. This 252,000 is my non-current liability for sure. But when I report in my balance sheet, I report my balance in two parts. And the two parts will be the 252,000, watch this here, the 252,000 minus, what did we say? What was the capital repayment? 48,000. Okay, therefore, 252,000 minus your 48,000 to give you a figure of 204,000. What's the 204,000? The 204,000 is your non-current liability. Okay, and the 48,000 will be the current portion of your loan. What have we done? We've separated the loan into two parts. And what are the two parts? The non-current and the current. Okay, guys, time for another break. See you in a jiffy.
All right, let's go take that break. Get yourselves relaxed, and we'll be back right after this. Welcome back, guys. If you've just joined us, just remember that you do not have to despair, because we are not that far into the show, and we also got a repeat show at 9:30. But now, Ashraf, what more do we have for the grade 12s?
Okay, you mentioned something to me about a rent question.
Yes, we've got a question from a mindset about rent income.
Okay, and there's the question on the rent income. Voila.
Voila.
Lucky you. I'll explain to you both the rent ones. Let's take this one first. Okay, what are we told? Rent income appears as 115,500, right? Included in the rent for included the rent. Let me read that again. Rent income 115,500 included the rent for March and April of 2014. The rent was increased by 500 rand per month on the 1st of October 2013. Okay, obviously your financial year would end on the 28th of February of 2014. Right, guys? Now, if there was no increase in your rental, then it was easy. All that you do is take the rent income figure and divide it by, because it's March and April, divide it by 14. But we can't do that. Why can't we do that? Because we have some months that have the old rental and some months have the new rental. So what are we going to do? Very simple. Watch what we do. We start off with 115,500, which is our rent income figure, right? Let's remove the increase, okay? Let's remove the increase. How do we do that? We say minus, open my bracket. When did the rent increase? The rent was increased in October. Let's count. October, November, December, January, February, but it didn't end there. Why? Because we also received the rent for March and April. Okay? So how many months is that? 7 months, Queen, am I right?
Yes.
Let's go back again and check if we got the right amount of months. It increased when? On the 1st of October. So that's October, November, December, January, February of this financial year, plus March and April. 7 months. Got that? So what do we say? 7 times, what was the increase? The increase was 500. Therefore, this bracket gives me a total of 3,500. Got it? Got it, guys? Simple. Right. Next step. What do we do now? Now we say, fine. Take the 115,500, 115,500, minus the increase of 3,500 to give me a value of, what was that? Let's try again. 115,500 minus 3,500 to give me a value of 112,000. Okay, now I have my figure of 112,000. What have I done? What have I done? I've made all the rent equal now over the period of how many months? And this is the critical part. How many months does this 112,000 represent? It represents 14 months. Why 14? Financial year ending February plus March and April. So we divide this by 14. So we've got our 112,000 divided by 14 to give me a value of 8,000 rand. Okay, now, what is the 8,000 rand all about? The 8,000 rand represents my rental prior to the increase. In other words, my old rental. Got it? Okay. Now, what do I want? What am I looking for in this adjustment? I am looking for, firstly, the amount of income that I've received in advance, also known as deferred income. So what do? If that was my old rental, plus the increase of 500 rand per month to give me a value of 8,500. Do you see the old rental plus the increase to give me 8,500? For how many months did I receive in advance? For 2 months. Therefore, multiply by 2, and that will give you a value of 8, 16, 17, 17,000. Is that right, Queen?
Yes.
Okay, 17,000. What do? 8,500 times 2 to give me a value of 17,000 rand. What is the 17,000 rand? The 17,000 rand is the income that I have received in advance. Okay, now, watch. In my income statement, when I'm doing my income statement, I will say, open bracket, 115,500, which was my initial figure that was represented, that one there, the amount of rent that I have received, okay? And what's my contra entry? Understand my contra entry. It's a debit to rent income and a credit to income received in advance, also known as deferred income. So therefore, by debiting my rent income, what am I doing? I'm decreasing my rent income. And how much am I decreasing it by? Minus 17,000. Okay, let's go to our calculator. 115,500 minus 17,000. My answer is 98,500, and that's the figure that will be shown in my income statement as the amount of rent income. Got that? That's the one where they give you the monthly rental. Now, let's just conclude this particular transaction by asking you the following question. What now happens with this 17,000 rand here? If we are doing the balance sheet, I need to include under trade and other payables. What do I include? I include an item called deferred income. I said also known as income received in advance, an amount of 17,000 rand. So you can see the impact is shown to you on the income statement and the balance sheet. It's important that you know both of them. Right, now, just one more thing. Let me just take this one step further. If you are told that you have received a deposit from your tenant, okay? So if you've received a deposit from your tenant, this means that that deposit is money that you have in your possession that does not actually belong to you, because when the tenant and the lease agreement ends, we'll have to give that back to the tenant. So where will it feature? If you have, now please understand the difference. Deposit water and electricity is a deposit we have paid to the council, and therefore that appears under trade and other receivables. It's an asset. However, a deposit that we have received is something that we owe to the tenant, and it will appear under trade and other payables, deposit for the rental. So you can clearly see that item, deposit on the rental, is an item that appears where under my trade and other payables. Please keep that in mind. Okay, now continuing with this rent one, just giving you another perspective. One of our mindsetters asked us and said, what about the percentage increase? Okay, the percentage increase is done as follows. Number one, take your old rental, make it equal to 100, okay, prior to the increase. So if it was for 6 months, you say times 6, which will be equal to 600. That's your old rental. Next question that you ask yourself, what was the increase in the rental? Okay, the increase in the rental was 10%, so 100, which was your old rental, plus the 10% will now give you 110. Okay, and you've received it 1 month in advance, so obviously times 7, which will give you 770, right? Okay, what do I do now? I add these two figures together. That means that will give me 1,370. 7 and 6, 13, 1,370 will be equal to the figure that's given to you in your income statement as the rental figure. What are you looking for? You're looking for the 1 month's rental that you have to take into consideration, and that's the 110, which is equal to your unknown. All you do is you cross multiply and you come to the answer. Voila, piece of cake.
Very
Chocolate
easy
cake.
and simple like that.
Okay, right? Okay, guys, so that's as far as the rental goes. Okay, let's move on to the next question. Prepare the following notes to the financial statements on the 28th of February, and we are expected to do the share capital and the retained income note. Okay, let's start with our information. What do we have here? One, of the 500,000 authorized, that means this company had an authorized share of 500,000. Remember, authorized is the maximum number of shares that the company is allowed to sell. What do? 400,000 were issued by the end of the year. Okay? So we've sold 400,000 of those 500,000 shares. Right. We are told that 3/4 of these shares were issued for 600 cents each in 2009. That means my balance at the beginning of the year. So in other words, what are we looking at? This is what we are looking at. 500,000 is my authorized. There goes. That's the maximum that I'm allowed to sell. I've sold 300,000 ordinary shares in issue at the beginning of the year at 6 Rand per share to give me a value of 1,800,000. Okay, now, going back to my question, what happened further to that? A quarter was sold at 780 cents per share on the 20th of February 2014. That means we had a further issue of shares and we sold. How many shares did we sell? We sold a quarter, right? So obviously a quarter of the 400 would be 100,000 shares. A quarter of 400,000. So therefore, what do we say now? We say we sold a further 100,000 shares. Were sold at what price? We sold those shares at 7 Rand 80. So therefore, at 7 Rand and 80 cents, okay? And obviously, very simple calculation. We take our 100,000 shares times 7.8 to give me a value of 780,000. So there's my 780,000, the value, 780,000, the value of the new shares that I sold during the year. Right, let's go back. These new shares were sold cum with dividend, right? That brings me to another point. Always check whether the shares were sold with dividend, meaning cumulative from the word cumulative, or were these shares sold ex-dividend, excluding a dividend. The question will direct you and tell you how these shares were sold, right? At the end of the financial year, the 28th of February, 20,000 ordinary shares were repurchased for 800 cents per share. Aha. We had a viewer, I think, one of our mindsetters, that asked about the repurchase and the buyback of shares.
Yes.
I hope you're listening to us, because this is where we're dealing with your specific question on the buyback of the share. Right, now watch this here. We bought back 20,000 ordinary shares. Okay, so therefore, in my note, I've got here 20,000 shares were bought back, but now, the important part, I'm dealing with my ordinary share capital note, isn't it? And in my ordinary share capital, I can only work with the average price of the share. I repeat, in my ordinary share capital note, I always work, when I'm doing my repurchase, I work with the average price per share. And how do I calculate the average price? Very simple. I take the number of shares that I have purchased, that I have sold, coming back, I take the number of shares, which is 400,000 shares that were sold during up to date, right? And then I take the value of those shares, I divide to find an average. I'm sure I've heightened your interest in this question, so you're going to take a quick, refreshing break, and when you come back, we'll continue with this very important question. Over to you.
All right, mindsetters, don't go anywhere. We'll be back after the break. Welcome back, grade 12s. We hope you guys are all ready and refreshed as we continue with the show. Ashraf?
Okay, let's carry on. I know you've got hundreds of questions.
There's
They
tons.
piled up, I know. We'll try and take them. Let me just finish this here, then we'll take that question of yours.
All right.
Okay, mindsetters, coming back. Watch. What have we done? Just to refresh you, so you know you don't lose track of what we've done. We've sold, or we've issued 300,000 shares at 6 Rand to give us the 1,800,000. At the beginning of the year, we had a further issue of 100,000 shares at 7.80 Rand to give me the 780,000. Now we have a buyback of shares. We bought back the shares at 8 Rand. Do we use the 8 Rand in the ordinary share capital? The answer is an emphatic no. No, you don't. The 8 Rand is the total price that we are buying that share back. What do we put into the ordinary share capital? We will put into the ordinary share capital the average price. Watch what we do. We say, fine, take the 1,800,000, okay? 1,800,000, 1, 2, 3, right? Add the 780,000 to give me a figure of 1,878,000. That's the value, the monetary value of those shares that have been issued, divided by what? The number of shares represented by that figure. So obviously that would be 400, 1, 2, 3, to give me a value of 4.65. Did I do something wrong? Yes, I think I did. Let's try again. 1,800,000, 1, 2, 3, plus 780, 1, 2, 3, to give me a value of, is that right? 1 million? Just check the maths. Is that correct? 1,780,000. Is that right? Okay, divide that by 400, 1, 2, 3, to give me a value of 6 Rand 45. Thank you. There goes. So 6 Rand 45, grade 12s, is the average price of my shares. What do I now do? I say 20,000 at 6 Rand and 45 cents. Watch that. What have I done? I take the average price in my ordinary share capital note. So therefore, we say 6 Rand 45 times 2123 to give me a value of 129,000. Remember, 129,000 is what I'm repurchasing from my shareholders. And then, what do we say? We say, fine, 1,800,000 plus 781,223 is equal to that, minus 129,000 to give me a value of 2,451,000. 2,451,000. Now be careful. This is represented now by 380,000 shares. Now watch this, please. And this is important. These 380,000 shares. Let's do this so you can see what I'm saying. Take that divided by 381,223, and you will notice, what do you notice? That you are left the remainder of the shares, the price at which they are appearing in the ordinary share capital account is the average price of 6 Rand and 45 cents. Got that? Great stuff. So see this here, that these are the remainder of the shares, and they stay at 6 Rand 45 cents in your share capital account. Okay, that deals now with the share capital. Let's go on to the retained income. Obviously, in your retained income, you're going to take your balance at the beginning of the year, right? And obviously that will be a given figure. But what we want to illustrate in this question here is the following. There's my retained income at the beginning of the year, 580,500. So we slot it in. 580,500. That's my balance at the beginning of the year. I'm asked to calculate the net profit after tax. Okay, now I look at my information and I see that nothing is mentioned about the net profit. So what do? Panic? Certainly not, guys. Remember, what we always tell you in accounting, and we're going to stress it one more time, RTFQ. Queen, do you remember this acronym?
I have no idea.
No idea. Well, Queen, this is what it's all about. Read the full question. What does this question tell us? Watch here. There's my earnings per share of 165 cents per share. So if I have my earnings per share, based on my earnings per share, I can calculate what? My net profit after tax. That's right, because obviously you have to know your financial indicators, and your financial indicator for earnings per share is what? Net profit after tax. It's your net profit after tax over number of issued shares times the 100 cents over 1. We know the answer. So in other words, this now becomes my unknown. Do you see what I'm saying? They're not asking you to calculate the net, the earnings per share. They're asking you to calculate the net profit after tax. So very simple, guys. In order to do that, let's go to our calculator and we say 1 Rand and 65 cents. That's 165 cents divided by 100 times 380,000 will give me a value of 627,000. What is the 627,000? The 627,000 is my net profit after tax. Okay? So, back to my 627,000 is my net profit after tax. Okay, so remember, there may be a need to calculate this net profit after tax. As you had seen in this particular example, you had to use your financial indicator. Which one? The earnings per share, in order to do what? To calculate your net profit after tax. It may be that you are given the tax rate, and you are given the net profit before tax, and you have to calculate it using the tax rate. Look at the question, and based on what you require, I'm sure the question will have enough for you to be able to calculate the net profit after tax. Okay, now what do we bring in here? Do you recall that we repurchased those shares at 8 Rand? Let's refresh your memories. These shares were repurchased at 800 cents per share. Okay, we only dealt with the 6.45 Rand as the average price in the ordinary share capital. This means that this company has retained some of that money in the retained income account. Okay, while we're at it, let's ask the question here, just to make sure, to show you how comprehensive your questioning could be. For example, if the question says, why do companies retain funds? Very simple. One, for future expansion, okay? And number two, for equalization of dividends. What do I mean by this here? There may be a time when the company goes through a lean patch because of a decline in the economy. And therefore, in order to keep shareholders happy, what would they do? They would try and keep their dividends equal to the previous years or close to the previous years, and that is why companies retain profits. So what is it? One, for future expansion, and number two, for equalization of dividends. Right, okay, coming back to this question here, right, what did we say? 6.45 Rand was the average price per share. So obviously, if we say 800 cents minus 6.45 cents will tell you there was a price above the average price of how much? 155 cents. Okay, multiply that by 20,000, because that was the number of shares that we bought back. And the value is 31,000 Rand. Okay, what have I done? Let's go through it again. The value of the shares were what? 6.45 Rand was the average price. We had purchased those shares at 800 cents. That means we bought it above the average price. How much above the average price? 8 Rand minus 6.45 Rand. So 800. What did we say? Let's do it once again. 800 cents minus 645 cents is equal to 155 cents. Okay, now multiply that by 20,000 to give me a value of, divide that by 100 to get the cent value, to give me a value of 31,000 Rand. What is the 31,000 Rand? The price above the average price. Now, what happens to the 31,000 Rand? This is what happens to the 31,000 Rand. Here, I say 31,000, and remember, I'm going to subtract it. This is the repurchase of shares. How many shares did we repurchase? We repurchased 20,000 shares at 1 Rand and what was it? 65? What was it? 800 minus 645, 1 Rand 55, okay, at 1 Rand 55. So, notice, the average price goes into the average, into your share capital note. There's it. You see it? And the price above the average price goes into your retained income note. That is the repurchase of the 20,000 shares. Now, just on this point, one more point that I need to illustrate. Yes, when you are doing the cash flow statement, right? Under financing activities, when you say the repurchase of shares, what are you going to use? Watch. If you're doing that one, you're going to say, under your financing activities, you're going to say repurchase of shares. How many shares did we repurchase? We repurchased 20,000 shares at 8 Rand, and therefore that value will be 160,000 Rand. So in other words, the total amount in your cash flow statement, you want to know how much money left your bank account. So in other words, let's identify the double entry. What's my double entry when it comes to the repurchase of a share? We debit ordinary share capital with what? With the average price. Okay? We want to decrease the ordinary share capital. We will debit the retained income with what? With the price above the average. Okay? Obviously, this is not a required, I'm just showing you and explaining to you. That's why I'm writing these things down for you. And you will credit your bank with the total amount of money. In other words, in this case here, 160,000 Rand, you will credit your bank account. This means, therefore, grade 12s, whenever you are dealing with a buyback of a share, keep the three components in mind. One, a debit to ordinary share capital, average price. A debit to retained income, the price above the average price. And a credit to your bank account with the total amount of money that is leaving your enterprise. Okie dokie. I think I need a bit of a break.
I think maybe you'd also like a bit of a break.
I think so. I need a break now, guys. So, time for a break. But again, let's take a quick break, refresh, and wait for the next question.
Yes, guys, we will see you after this. Do come back. Welcome back, grade 12s. We are now in the last segment of the show. And if you have just only tuned in with us, don't worry, we still have a repeat at 9:30 p.m. So then you can also catch that repeat. But for now, Ashraf will be finishing off and wrapping up for us.
Okie dokie. Let's get into that question that we were busy with. Remember, we're busy with the retained income note, Queen. Right?
Yes.
And what do we have to bring in? We have to bring in the dividend that has been paid. Right? And the dividend that has been declared. Okay, so with regards to the dividend that has been paid, let's see, what did it say? It says there, an interim dividend of 60 cents per share was paid. The new shares that were issued did not qualify. That means they were sold ex-dividend, excluding the dividend for the interim dividend, and did not qualify for the interim dividend. The question is specific. So, how many shares did you have? You had 300,000 shares at the beginning of the year. Therefore, you're going to take your 300,000, right? Multiply that by 60 cents. Okay, let's do that. It should give us 180,000, but let's just check it out. So we got 300,000 times 6, and the value is 180,000. There is my interim dividend that has been paid. Okay, right. Then the dividend that was declared at the end of the year. What do we know about the dividend that was declared? Let's find that one. Here's it. A final dividend of 80 cents per share was declared at the end of the year. All your shares now qualified for that dividend. Therefore, you now have 400,000. Even those that were sold. Remember, the question is specific here. It says here, these shareholders were entitled to the final dividend. That means all the shareholders. How many did we have now? 400,000, and the value of the dividend was 80 cents. Therefore, all we do is 400,000 times 8, and that gives me a value of 320,000. Here goes 320,000 is the final dividend that has been declared. Okay, We're not going to balance this. You can do that for yourself. And obviously, you know what you're going to do here. Just to show you how to complete this retained income note, it's that plus your net profit after tax, less your repurchase, less your dividends. Okay, we can add that for you. 320, 400, 500,000 is the total dividend for the year, and then obviously the difference would give you your final balance in your retained income note. Okay, so that deals with the retained income as it affects the repurchase of shares. Okay, I think you've got a very important question for me there.
Yes, we've got a question from Ridwan, and he wants to know, in the cash flow statement for the cash generated from operations, please explain changes in the working capital.
Right. A very important one. When you're working out your changes in your working capital, there are 3 items that you look at. 1, you look at inventory, right? You look at trade and other receivables. And the third one that you look at is your trade and other payables. So these 3 things are what you're going to be concentrating on in order to calculate what? Your changes in working capital. Right? Now, very important, Mr. Ridwan, when you're looking at trade and other receivables, exclude what? SARS income tax if it has a debit balance. And why do I exclude it from this calculation? For one reason only, because it has its own note. Okay? So keep that in mind. When I'm doing my comparison from one year to the next year, and yes, when you're doing your comparison, remember, if that is 2012 and that is 2013, just to illustrate for you, always draw the arrow. That's right. What do we call that, Queen? The love arrow. Okay. If it's misdirected, it creates a havoc in your life, isn't it? So therefore, grade 12s, in the cash flow or wherever else you are given 2 years, if the arrow is misdirected, it's going to create a havoc in your accounting paper, and you don't want that to happen, do you? So therefore, identify the beginning of the year and the end of the year. Right, coming back to our comparison. So, exclude SARS income tax if it has a debit balance. It will obviously appear under trade and other receivables. And secondly, when you're dealing with trade and other payables, here you're going to exclude SARS income tax if it has a credit balance. So the point I'm trying to illustrate to you here is that SARS income tax could appear as a receivable or it could appear as a payable, depending on the balance. And the question that I always ask, what type of an account is SARS income tax? And the answer to that is, it depends on what? On the balance. If it's a debit balance, it's a trade and other receivable. If it's a credit balance, it's a trade and other payable. Got that? Okay, coming back here. Now, when you do your comparison here, what do you use? Okay, what we're going to use is the following. We're going to use German. Okay, we're going to teach Queen some German today. And that is what? How you pronounce it is not important. What you understand from it is critical. We call it Ayulich, the German one. What does it mean? It means that when an asset increases in value, you are utilizing funds. So for example, if my inventory, right, compare 2012 to 2013, my inventory was 100,000. My inventory is now 200,000. What has happened to my inventory? My inventory has increased in value. In other words, what impact is this having on cash? You will find that you had to utilize your cash, and therefore your answer to this one here will be 100,000 being the difference between the two. Can you see? It was 100,000, it became 200,000. There was an asset increasing in value. You utilize. Now watch this, important. The U tells you that this answer has to be in a bracket. You see that, Queen?
Yeah.
Watch, U formation tells you bracket the figure. Okay, so this means that you have utilized 100,000 rand worth of cash to buy more inventory. Okay, carrying on with our German. When liabilities increase in value, it means that we generated cash. What does that mean? It means that we got in money. So use this acronym when you are working out your changes in working capital. And then we're going to teach Queen some French. French in an accounting show? Let's see. Ed Gledu. What does this mean? It means that when an asset decreases in value, we are generating cash. Can you see that? And when a liability decreases in value, we are utilizing cash. Let's take the asset decreasing in value. For example, if you're looking at your trade and other receivables, once again, 2012, 2013, right? My assets were 80,000 last year, are now 20,000. Which asset? Trade and other receivable. Obviously, the question that you are asking, number one, there's your comparison, there's your arrow. My assets were, which ones? Trade and other receivables were 80,000, are now 20,000. What happened to the asset? It decreased. That means we generated how much? 60,000 rand. And a generator tells you that it is a positive figure. Okay, so keep that in mind when you are doing your changes in your working capital. So to recap, 1, you look at inventories. 2, you look at trade and other receivables, but the exception in trade and other receivables is that you exclude SARS income tax. And the reason you are excluding SARS income tax is because it has a note of its own. That's the only reason. And then you compare your trade and other payables, and there you exclude 2 items. What are the 2 exclusions? One would be your shareholders for dividends, right? And obviously your SARS income tax if it has a credit balance. So therefore, keep them apart because they have notes of their own. They appear in their own calculations where you're going to have to calculate what? You're going to obviously have to calculate your taxation paid. You do know that this will feature as a separate item on your cash flow statement. Yes, you're going to have to calculate the amount of tax that has been paid. Once again, a quick review on this one here. When you're doing your SARS income tax, you want to calculate your taxation paid, bring in your opening balance. It could either be debit or it could be a credit balance, depending. Right. Number 2, bring in your closing balance. Same story, either a debit balance or a credit balance. Bring in your taxation amount from your income statement. So that will be your taxation amount from your income statement, and voila, using that, you then determine the actual amount of tax that has been paid. Well, grade 12s, we tried to take as many questions as we could. We were flooded with questions. All that's left from our side now is to wish you well. We wish that you will definitely aim for the moon. Because if you're not going to get there, definitely you're going to be a shining star. Ashraf's shining star.
Oh, wow. Wow. What nice words of advice from Ashraf. Thank you so much, Ashraf.
All
I'm
your
sure the
pleasure.
grade 12s appreciate all your hard work
All your
and
pleasure.
all your help. Guys, all the best for tomorrow's exam. Please make sure that you get enough sleep. Make sure that you arrive on time. And I mean, that is all that we can do. Now it's all up to you to put in the hard work and effort and just relax. You have got this. This is the end of the show. We will see you guys next time. Goodbye.
Cheers.
All the
Bye-bye.
best,
Good
grade
luck.
12s.
Good luck.